Hi there everyone, and welcome to a very special show, Your Portfolio with Nilesh Shah. This is the first time ever that we wanted to encourage all of our loyal viewers of ET Now to come personally, meet, greet, and of course get all of their questions answered by none other than ace investor Nilesh Shah. So let's bring on board the man of the moment right now, Nilesh Shah, who has 25 years of experience over that in the financial and capital markets. He's managed funds across equity, fixed income, securities, and real estate. Managing Director and CEO Kotak AMC, who really needs no introduction. Thank you, Nilesh, for joining us in the studios. And I just also want to introduce all of our guests and who will be with us, all of the viewers who've connected with us on the show. We have Hiren Shah in our studios, Dwiti Adesara as well in our studios. And joining in, we also have Medvi Pandey, who is joining in on Skype all the way from Kuwait, as well as Mr. B.V. Mallikarjun Rao from Kharagpur. Thank you so much, all of you, for connecting with us. This is your opportunity to ask your questions to Nilesh Shah. Nilesh, but allow me to do the same. Let's just go by the age-old saying. Benjamin Franklin said, an investment in knowledge always pays the best interest. And you have a lot of that knowledge. So please do enlighten us and share with us, because your presentation indicates that one should prepare for an investment in equity markets like joining the ride. So you lock the belt and just go for it. What are your key, golden words of wisdom?
So one, there's no free lunch in the world. The risk and returns are two sides of a coin. And no matter how many shows you attend, but there's no one who can differentiate risk and the return. For every return, you have to take risk. And clearly over the years, we have seen that equity markets have delivered great return to investors, but a lot of pain to the traders. And the best way to invest, the best way to make money is through the equity markets. Be a long-term investor, be a disciplined investor. That combination of long-term and discipline creates enough wealth for everyone in this equity market.
Long-term and discipline. So those are the two golden rules. We will be talking a little bit more about, the ideal portfolio allocation in mutual funds. But first up, let's go across to Hiren Shah. He is a certified financial planner, and he has investments in mutual funds close to about 8.5 lakh rupees, 32 years of age. Thank you, Hiren, for being with us in our studios. I'm sure you have a ton of questions for Nilesh Shah. So let's start off with the first one on top of your mind.
SEBI makes it mandatory to say mutual fund investments are subjected to market risk, and we should read all the documents carefully. But still, too much of information, or say the retail investor, always like us, always have a problem where we do not understand the market and we tend to go with the ride, but we end up making losses. As for Kotak Mutual Fund, what is your policy regarding this when it comes to investor protection, or at least, educating us regarding the same?
Sure. So here in equity markets are like a boxing ring. When you enter, you have to be ready to take the punches. There is no solution which can protect you against that. If you want return, you have to take the risk. And the best way is to take the calculated risk. So let's say at Kotak Mutual Fund, we believe that if we can educate investors about the need to be long-term investor, the need to be disciplined investor, the need to invest via regular investment systematic plan, I think that's more than sufficient. While my job is to empower my distributors rather than my investors alone, so we spread the knowledge through our distributors, through our advisors. We equip them with statistics about market. We talk to them on a regular basis. We try to hand over them information material. But at the end of the day, there is one pull and then there is one push. The investor also has to take the responsibility of learning from things which are available. And at the end of the day, my recommendation is that every investor should, get that Gandhiji's 3 bandar. Gandhiji's three bandar were talking about don't look bad, don't speak bad, don't hear bad. But in financial market, they say be a long-term investor, be a regular investor, and do your asset allocation. Follow these three things and you will be safe.
So that's what you're advising right now, Nilesh. Well, take it firstly. Hiren, are you excited to meet Nilesh Shah? I'm sure this is an opportunity that you've been waiting for quite
Yes,
some time.
absolutely.
Have you been following him for a while?
A while, yes.
Yes. Okay, great. We also have Dwiti with us in the studios. Dwiti, thanks so much for joining in. What's your question for Nilesh?
Hello, sir.
Hi.
So, since I'm a first-time investor, I wanted to know that what would be the right portfolio for getting a strong returns for someone who has no knowledge about, say, investing anywhere, like for the first time.
So Dwiti, every single investor has to make someday a beginning. Warren Buffett also, when he started, was as fresher as you were. The thing is that there are two models. One is the Eklavya model, where you start learning about stock market on your own. It requires lots of things: reading of balance sheets, meeting management, analyzing news, forecasting business models, and so on and so forth. And some calls go right, some call goes wrong. But if your right calls are more than the wrong calls, then you start making money. The second model is taking professional help. Now you might be busy, you may not have time, you may not have inclination for doing all the work which is required to become like Eklavya, self-learner. Then you can hire an advisor who will tell you how to allocate your portfolio, and then you can pick up mutual fund schemes which achieve the same purpose. Obviously, when you invest directly, you have different risk profile. As mutual fund managers, we optimize risk rather than maximize risk, and to that extent our returns get moderated. But if a person is a long-term investor, then Indian equity mutual funds have delivered fantastic return to them. And in fact, over the last 20-25 years, what I have seen, that many of the investors who invested directly into market, because they were actually traders rather than investors. They bought when the past return was attractive and they sold out whenever markets corrected. Instead of, if they had invested just in mutual funds and slept on it, they would have made far more money. So either you get the knowledge and the skills so that you can manage money on your own, or you hire advisor who will help you build portfolios via mutual funds, via direct stocks or other things, so that you can achieve your dreams.
So sit back and leave the rest to the experts is also,
Absolutely.
very advisable. But at the same time, Nilesh, it's so crucial to get the timing right when one should really enter the markets. And maybe, a lot of first-time investors would also like to know, can you stress on a little bit about the importance of timing? And I'm going to squeeze a question as to what your outlook is for the markets as well.
Sure. So my advice will be that it's time in the market which makes money for you rather than timing. Now, Sachin Tendulkar is one of the finest timing in cricket. But would he have made so much runs, so many centuries, if he was timing the ball always, but not spending time on the pitch? He would have scored about 15,000 odd runs, and for that he spent 30,000 balls. He faced 30,000 balls on the pitch. Now, person with that kind of luck, that kind of commitment, that kind of skill, didn't hit every ball for a 4 and 6. So when you are entering stock market, please be aware that you are not Tendulkar. You can't hit every ball for a 4 and 6. Stay invested for a longer period of time. Markets will start working magic for you. Our outlook on the market remains bullish. We are bullish because we take a longer term view. When I started my career, Indian GDP was $250 billion. Today it is $2.2 trillion. And as GDP went up, the market capitalization went up. Now, over the next 7 to 10 years, we expect GDP to double from current level, from 2.2 trillion to 4.4 trillion. If GDP goes up, market cap eventually will follow. Now, imagine in 25 years, we have seen $2 trillion worth of additional GDP. In next 10 years, we'll end up seeing $2 trillion worth of additional GDP. So what we saw in 25 years in terms of wealth creation, the same thing will get repeated over next 10 years. This is your opportunity to grab equities, pick up the right stocks, pick up the right management, and stay invested. The
And do
rising
some right
tide will lift
batting as well.
everyone.
and get the right technique for batting as well. Okay, let's connect with the next viewer. Nilesh, thanks for that. And we've got someone joining in from Kuwait on Skype. We have Medvi Pandey, who is a business development manager, 33 years old, now joining in, and a very long-term time horizon of the next 15 years. And Medvi, I believe the goal is eventually child's education, self-retirement, as well as marriage. Tell us about what your question is for Nilesh Shah.
And my question is like how to evaluate the fund performance. I have been investing in some of the funds who have been beating the index returns, but for last 3 years and 5 years they have beaten the returns. But how to evaluate if these funds will continue to bypass like beat the returns of index returns? So how to evaluate them?
So Medvi, the way to evaluate any fund is based on its process rather than the performance alone. So if in the past fund manager has been consistently beating benchmark indices, then certainly he is a good fund manager. And like, every batsman has a bad day. Sometimes good fund manager also have a bad day. They may underperform market for a while, but their process is such, their confidence is such that it invariably results into bounce back. One way to evaluate fund performance is looking at the quality of the portfolio. Are these the companies which you believe are blue chip quality companies, or are these the companies where prices have run up way ahead of their fundamentals? Is the portfolio manager doing momentum chasing, or is he doing quality investment? Is the portfolio having huge turnover ratio? If yes, then this is more like a trading oriented portfolio rather than investment oriented portfolio. When the fund manager is speaking about his investment process, is that reflected into quality of portfolio or not? So there are various parameters from quality of portfolio, fund manager speaking versus actual action, portfolio turnover ratio, alpha generation over benchmark indices. These are all the parameters which help you evaluate whether the fund is doing well or not. If you can't track all those indices, it's far better to take the help of an advisor who continuously monitors this and then gives you the funds which he believes will outperform the market. But as I mentioned earlier, please remember that the form is temporary, but class is permanent. Every good fund manager may also suffer a bad day. Don't sell out good fund manager's fund when he is underperforming, because maybe that's the best time to invest as he will bounce back.
And Nilesh, that's the checklist of what you should follow. But being a veteran in the markets, I'm sure you've seen investors make a lot of classic mistakes, get burnt in the equity markets, burn their fingers. So what's the advice that you would say, so some principles of what not to do?
So one, investment is not about lottery, or it's not about getting rich overnight. It's all about long-term investment, discipline, patience. So please remember the differentiation between trading and investment. In trading, when you incur loss, you cut loss. In investments, if you incur loss, then it's generally leading to averaging. You buy more when things have become cheaper rather than sell, unlike in trading. The second thing, trading requires short-term reflexes, short-term horizon. Investment requires longer-term perspective. So when you want to trade, it's short-term. When you want to invest, it is long-term. Third, you don't look at past performance and invest. You look at future potential and invest. And this is an art. This is not a science. You have to gain the experience to understand stock market. It doesn't happen overnight. It takes time. But unless until you put that effort and that sincerity, you're not going to get results out of the stock market. So it's all about managing your emotions, balancing between greed and fear, putting in efforts to understand the market and the cycle, and then staying committed, staying disciplined to make long-term wealth.
Okay, so it's key to differentiate between investing and trading, and then follow some of these rules as well. Well, we've got another caller now joining in, B.V. Mallikarjun Rao, who's a railway employee, 39 years old, from Kharagpur, with a time horizon of 20 years. His long-term goal is retirement and buying a house. Mr. Rao, thank you for connecting with us on Your Portfolio with Nilesh Shah. Tell us what is exactly is the question that you would like to pose to him.
I want to ask especially three questions. One question is that if anybody investing in for how many funds he can invest,
Okay.
and what will be the portfolio allocation, and the third question is the CB new CB guidelines will be come into force, which will define the large cap, multi caps, and small cap, mid cap. Then what will happen to the existing portfolios if we are at present investing in mid cap funds, which are already investing in some large cap stocks also. So what will be the change then in the existing funds?
Okay, thank you for sending in those questions. You want to start with the first one?
Sure. Mr. Rao, the thumb rule is that 100 minus your age is the allocation towards risky assets. So let's assume you are 39 years of age. So about 61% of your total wealth should be allocated to risky assets like equity, gold, real estate, and about 39% should be invested into safer assets like fixed deposits, debt, mutual funds, tax-free bonds, provident fund, and so on and so forth. Now, obviously, every 39-year-old does not have same risk profile. So then you have to decide, am I aggressive, am I conservative? If you're conservative, then make 61 maybe 50%. If you're aggressive, make 61 maybe 75%. But maintain one anchor allocation based on your risk profile and investment objective. Now, how many schemes one should have in a portfolio? Ideally, you should not have more than between 8 to 10 schemes. There should be few large caps, few multi caps, few small caps, and if you're comfortable with them over 3 to 5 years, then you can start adding some of the sector schemes. In terms of what will happen with the SEBI guidelines coming into force, one, it's going to take about a few months before it becomes operative. More importantly, today, when you are investing in small and mid cap fund, in some funds you get pure small and mid cap exposure, in some fund you get blend of large cap exposure. So now SEBI wants to make products more transparent to you. If you are investing in large cap, you should get large cap exposure. If you are investing in small and mid cap, you should get small and mid cap exposure. So impurity of the portfolio is being taken away. The portfolios are made true to label, and I think it will be good for the investors. Now you will be getting what you are buying for.
This is the show where you can get them answered with none other than Nilesh Shah. Stay tuned, we'll come back after a quick break. Welcome back. You're tuned into Your Portfolio with Nilesh Shah. Yes, dreams do come true. You can meet ace investor Nilesh Shah in the studio and pose any questions when it comes to investing. And we have some viewers with us right now as well. So thanks so much for staying on. Hiren, you spoke about some of those rules and regulations when it comes to investing. What other questions do you have for Nilesh?
Recently, SEBI also came out with lowering the TER, the total expense ratio. It's good for me as an investor, but does that impact the services that I get from the mutual fund in somehow? Because after all, for some quality of service, I need to pay something.
Undoubtedly, Hiren, as the economies of scale comes in, TER has to come down. And I don't think so service standards will get impacted by lowering of TER. All of us are quite careful about the brand which we have built over last many years. And yes, all of us are running commercial organization. We are not charitable organization. But we have to create a situation which is win-win for all three partners, the manufacturers, which is us, the distributors, which is distributing the product, and the investor. And market is the best judge. And SEBI has been nudging for lower expenses over a period of time, which is perfect. So there won't be any impact on our services. In fact, it will keep on improving. In Indian mutual fund industry today, we are a step ahead of the global industry in terms of transparency, in terms of disclosure, and we will continue to maintain that.
Nilesh, you've spoken about cricket, bungee jumping, boxing fields, but what about your general outlook? If one were to take the plunge, get into the boxing ring right now, where are you seeing comfort in the current market?
So let's assume that this is a
Less
first-time
punches.
investor like Dviti.
Yeah.
So I'll recommend her to start with MIP or equity savings scheme kind of exposure. It's 15 to 25% equity. Now you invest money and Murphy's law apply. Moment you invest, market crashes. It invariably happens with the first timers. No problem, markets have come down. Now you move this money into balanced fund. That's about 70% equity exposure. The God wants to take your trial again, so market goes further down. No problem. You move from balanced fund into large cap fund, which is 100% equity. Now there is a fire sale in the market and market goes further down. Doesn't matter. Now you move from large cap to small and mid cap funds, which is again 100% equity. What have we done? We have bought more equity, more aggressive equity when the markets have become cheaper. Please remember that when 100 becomes 10, you lose 90%. But when 10 becomes 20, you make 100%. When 20 becomes 40, you make another 100%. And if you ride entire journey from 10 to 100 back, you make 900% return. So you get 1:10 ka bhav in equity market from downward to upward journey. So you take risk when it is more appropriate. So for conservative investors, for first timers, we'll recommend to start with hybrid scheme, go to balanced fund if market corrects, and go further to large cap or mid cap if market gives more correction.
Okay, so that's the approach that you're advising right now, and the importance of even risk and timing is very crucial. Dwiti, do you have another question for Nilesh?
Yeah. There has been much debate about real estate and investments given the price correction. What is your view about investing in real estate?
So one should always invest in real estate, provided one knows how to invest in real estate. Typically, we have seen that if you invest in a real estate where city is moving out, then that real estate generally doesn't give you great return. So for example, in Mumbai, a Ballard estate or a fort, which were once thriving commercial center, now has given way to BKC and Lower Parel. So obviously investors who invested in Ballard estate or fort property haven't made as much money compared to the guys who bought properties in BKC or in Lower Parel. So always try to invest in that real estate where which side city is moving to. Second, what we have seen is that in the real estate it is always difficult to estimate the execution of a project. So go with reputed builders, go with builders whose project will get executed. It should not happen that you put your money and then the project is stuck. Then the benefit of returns will not come to you. Third, today residential rental yields have come down dramatically, whereas the commercial rental yield is almost equivalent to bank FD rate. So it might be better to invest into commercial real estate rather than residential real estate. Put all these things together, commercial real estate, in a direction where city is developing with a reputed builder whose project will guarantee execution. That's the way to invest in real estate.
Okay, and I'm sure a lot of people's doubts were cleared because they would have had questions when it comes to investing in real estate. But we also still have with us, we have Madhvi Pandey, who is still on the Skype line. Madhvi, do you have any more questions for Nilesh Shah? We can squeeze in a few before we wrap up.
I have one more question, like how is debt as an asset class, and how can we as an investor can take benefit out of it?
So Madhvi, debt is an important asset class, and while it does deliver lower return than fixed income over a period of time, it also gives lower volatility compared to equity over a period of time. In the Indian context today, the government securities are giving decent yield. They are actually giving real rate of return compared to the past. So one can invest into government securities, one can invest into corporate debentures, one can invest into what we call credit opportunity fund. These are all the debt instruments which are available to an investor, and for a conservative investor, for a retiree, debt must form an important part of their portfolio. The objective to invest in debt is to get little return over inflation. You should get real rate of return by investing in debt.
All right, Nilesh, on that note, would like to thank you so much for joining into our studios and helping out our viewers from real estate, debt, mutual funds to portfolio allocation. We've covered everything, and thank you all so much for joining in and being with us on the show, posing your questions. And with that, from everyone that put the show together, thanks so much for watching. Here's wishing you a crackling, a happy and a prosperous Diwali.